Hello friend, today's video is going to be about financial markets. Usually, entities use financial markets for two main reasons. The first one is to avoid losing money, and the second one is to make money. When we talk about the fear of losing money or risk aversion, it's caused by the fear of the depreciation of an asset that we own. For instance, that can be the case of a portfolio manager who's expecting the price of equity to drop, and as a result, he decides to use derivatives to hedge against the risk. And if you have no idea about derivatives, those are simply agreements between two participants to make a transaction after a certain period. Practically, it's going to be a contract to either buy or sell a stock, a currency, or even a commodity after, let's say, 1 year. It can also be an exchange of the interest rates related to some loans in the case of swaps. Also, risk aversion includes the change of the value of a cash flow that we will neither receive or pay in the future. For instance, if a French company must buy a certain commodity in 1 year and needs to make the transaction using yen, then either euro going down or yen going up can generate losses for this company. As a result, using derivatives might be a way to hedge against risk. In the opposite scenario, some people are ready to take risks in the hope of making money in the future. So in simple terms, it's like transferring today's money to the future with the expectation that this money will be worth more. And usually, the process of risk-taking is done in two ways on financial markets. As we have explained previously on the video about the fair value, markets tend to be volatile and random on the short term, but over long periods, it is always seeking a fair value. As a result, we can choose to capitalize on long-term movements by buying assets that are undervalued or that can perform well in the future and hold them for a long period of time. When it comes to overvalued assets, it's just better to ignore them. Because when you go short on an asset, in other terms, you sell something that you don't own by borrowing it from another participant, the losses can be unlimited. For people who don't know how it works, take a minute and think about it. It's super simple. When you buy something, the worst case scenario is the price going to zero and you losing all your money. However, when it comes to shorts, the worst case scenario is not only losing the amount of money that you choose to engage with, because if the price of an asset that you shorted goes up 100%, you will lose all your money. But it performs even better. You can lose a higher amount of money. For instance, if the price of the asset that you shorted goes up by 500%, you will lose the amount of money that you initially engaged with multiplied by 5. And since I love Keynes, let's quote him again. The markets can remain irrational longer than you can remain solvent. Moreover, there are two main methods of investing. You have active investing and passive investing. By the way, if this is a topic that is relevant for you, I have two basic books that you can start with. The Intelligent Investor and Security Analysis, both by Benjamin Graham. I will also make more videos about that in the future. Passive investing, aka the lazy approach, aims to construct a portfolio that closely mirrors a particular market index or benchmark. Concretely, it's like buying some stocks or bonds and aiming similar returns of an index. It may also be investing directly in indexes or buying a tracker, ETF. When it comes to active investing, it's more about beating the market by analyzing individual assets like stocks or bonds or even commodities and constructing a portfolio that is supposed to have higher returns than the market. And since the market doesn't offer any free lunch, these excessive returns can't be reached without taking higher risks. The second way of engaging in the marketplace is by simply capitalizing on short-term movements, and in this video, we will dive more into that. And when we talk about speculation or trading, it's a wide and vague concept, and the goal is not to tell you which type of trader you should be, but rather to explain to you how types of traders proceed, thus you can determine which approach or methodology is appealing to you. And of course, it's not a decision that you should make immediately. You just focus on learning and practicing. Let the time show it to you. This classification is not all-inclusive, and some attributes are of course lacking, but it's enough to have the basic understanding you need. 1. The first factor is about the asset class that you are trading, and there's no asset class better than the others. It's just a matter of preference, I guess, because each asset class has its own characteristics, whether it's trading time, volatility, market structure, or even price action. because some patterns are more common in some asset classes. When we talk about trading times, bonds and stocks typically have regular trading hours during weekdays, which can vary by country and exchange. In the United States, for example, the New York Stock Exchange, NYSE, and the Nasdaq are open from 9:30 a.m. to 4 p.m. Eastern Time. When it comes to forex, this market operates 24 hours a day. It opens in Asia and moves through Europe and North America as the day progresses. This continuous trading cycle is due to the global nature of the forex market and the different time zones of major financial centers. For commodities, the trading hours can vary significantly depending on the commodity and the exchange. For example, energy futures often have trading hours that align with stock market hours. However, some commodities, like gold and silver, can be traded 24 hours a day. Finally, as you may know, cryptocurrencies operate 24/7 without any breaks, simply because cryptocurrencies are decentralized and not tied to any specific exchange or geographic location. Moreover, volatility refers to the degree of variation in the price of a financial asset over time. And the only way to identify volatility is not by considering the variation of price, but rather by comparing it to the standard behavior of an asset. Concretely, a variation of 2% might be considered as volatile in the forex market, but for cryptocurrencies, it's simply a low value of variation. 2. The second factor is about the average duration of your trades. You can choose to keep a position opened for a few minutes, few hours, few weeks, etc., depending on the time frame you are using. This should be matching your lifestyle regarding your obligations as an individual and what time frames you are more comfortable with. Furthermore, the pattern you choose to trade, how often they repeat, and the time frame you choose will determine the frequency of your trading. 3. Moreover, we can classify traders through their risk aversion. And when we talk about the concept of risk in trading, it's not only about the percentage of capital you are risking in each position, but it goes beyond that. It's a combination of the frequency of your trading, your win rate, your psyche, and then finally, the percentage of risk per trade. Because when you think about it, this percentage shouldn't actually be static, and the same for everyone. To a greater degree, it should be the result and the reflection of other attributes. Once you have an idea about what timeframes you want to use for your analysis and entries and which pattern you're going to trade, you know the frequency of your trading. And this frequency should also converge with your personality traits and your psyche. Practically, if you have a high level of neuroticism and you struggle under high stress to take decisions, it would be better for you to avoid scalping and entries on low time frames and only focus on taking few trades each month. When we talk about neuroticism, it's simply the frequency in which you experience negative emotions. And we will develop more on that on the video about personality types and personality traits, and hopefully I will be able to integrate some tools on the website enabling you to take tests to find out about your personality type. If it's not the case, of course, I will provide you with enough information in the next video so you can determine it for yourself. Inversely, if you have a low level of neuroticism and you have no problem making decisions under high stress, you can simply choose to utilize low time frames as entries. But as a beginner, the easiest way to destroy your capital and your psyche is by trying to scalp. On the other hand, your strike rate will help you know which kind of drawdowns you're going to experience. When we talk about the strike rate, it's equal to the number of profitable transactions divided by the number of the total transactions minus the ones that ended at break even. So practically, if you have a trading model characterized by a high frequency, risking a high percentage of your capital can easily lead to large drawdowns, and going through drawdowns can have a huge impact on your psyche, which will make your strike rate even lower. As a result, you can quickly blow your account. So the best thing that you can do in this scenario is simply make the percentage that you risk super low, which will automatically make the drawdowns low as well. In a nutshell, you need to view the percentage of risk per trade as simply being a way for you to manage money, to limit losses, and make your equity curve growth in a sustainable way. And I know, this is not attractive as a process, but I prefer to just be honest with all of you. 4. The fourth factor is about your approach to trading, basically, your methodology. In this perspective, it's so difficult to classify the different approaches to trading because they are simply countless. But overall, you can either base your trading decision on analyzing fundamentals, like the financial statements of a company or economic indicators for the economy as a whole, or it can be more about the price action and pattern recognition. When we talk about technical analysis and the ability to analyze price action, we can simply say that you have two ways of analyzing price. The first one is the mechanical approach, which is trying to find a repeating phenomenon or a price signature and base your whole trading model solely on that. But by doing so, you disregard the narrative and the storyline behind price movements. Also, you have discretionary trading, which is basing trading decisions on discretion and trying to analyze the price on multiple time frames and see the context while trying to deduce the narrative. And narrative is simply how liquidity is going to be engineered in the future. Ultimately, your trading initially should be a combination of both. Your entries should always be mechanical and rigid, but when it comes to trying to understand what the price is saying and trying to do, that's on discretion. And you can make both technical analysis and fundamental analysis either manually or algorithmically. You can either choose to make your own forecasts or use an algorithm to do that. In the case of algorithmic trading, you also have two types of algorithms. Supervised learning that is done by giving direct instructions to the algorithm regarding the ways to analyze data, or unsupervised learning, which is just providing the algorithm with a bunch of data. Then, the algorithm will analyze this data and find on its own the repeating pattern. 5. For the last classification, it is more oriented towards the market cycle and what your eyes are jumping into when reading price action. When you see, for instance, this piece of price action, are you expecting the price to keep dropping or reverse? In simple terms, it's about what you're biased towards. We will see patterns that can lead to reversal and continuation patterns. You can trade both, but it's always better to focus solely on one. Furthermore, as a beginner, it can be so challenging to forecast reversal, so the best advice that I can give you is to focus on continuation setups primarily. Finally, I don't want you to think about these elements of our classification independently, because each one will definitely have an impact on others, and while going through the backtesting series, you will notice how you can enter the market in different ways. And I know that you are so confused right now, but these videos are just small pieces that we will gather later to have a broader picture.